Hello and welcome to Commodity Champions. I'm Anisha Gupta. The climate change woes have every major industry on the hunt for a perfect solution to decarbonize their businesses. However, the pace of transitioning to cleaner energy has been sluggish. Governments and industries have been trying to speed up the process, working in alliance to create greener and more sustainable operations. It's no surprise that climate change continues to be one of the top priorities of giant corporates. With 81% of organizations actively disrupting the energy transition sector, according to KPMG report, this report also states that 85% of businesses see technological disruption as an opportunity. The lack of viable alternatives to coal, steel and cement, however, continue to be a restraint as the phasing out of these raw materials accelerates crude's upward price trajectory. That also has been a cause of concern in the energy industry, with volatility hurting investments. So what is the energy sector's path to sustainability, and are countries' targets achievable? To answer that and much more, we are now joined by Paul Hickins. He's director at S&P Global Platts, and Anish Dey is global sector leader of the Power and Utilities Division at KPMG India. Gentlemen, hi. Thank you so much for joining us on CNBC TV18. Paul, to you first. And while the conversations about energy transition and climate change and renewables has been much on the higher side, how have you read that? And of course, the balancing act that we are seeing with the fossil fuels?
Yeah, I think it's about the ambitions of one side about meeting certain climate targets and the realities of where we're at. And that is, fossil fuels are for the here and now still. There's no replacements for some of these. And the real danger is the lack of investment going into, especially oil we're seeing, but across the fossil fuels. And what happens if the lights go out? And even under certain 2 degrees climate targets, even under those, the need for oil investments and energy investments in fossil fuels is still unlikely to be enough to meet some of those challenges. So from Platts Analytics perspective and our scenarios, the likelihood is that, for example, oil demand is likely to continue growing well into the next decade. And even after that, it's likely to be only a slowdown of, say, towards 108 million barrels a day of oil, even at 2050. So there's still a huge demand for oil, and the opportunities and the structure to try and get enough fossil fuels to meet that energy demand, complemented by renewables, is still a huge challenge, and the policies and technology is not quite there yet.
Absolutely. Anish, this one is to you. And while energy transition has been talked about by companies and countries and much more in this year, would you say that the pace of energy transition itself has been sluggish?
Yes, that's the history. I think the pace has been relatively slow, and but the hope is that it is going to pick up very quickly now, and especially after COP26, when there was a kind of convergence of minds. I think we should look forward to a faster trajectory on the energy transition. That might still leave us in some difficult places because global heating, global warming is already happening at a very accelerated pace, and we are seeing even today, we are seeing climate effects almost with terrible regularity and intensity. But my hope is that it's going to pick up now.
Sure. But, Anish, on the other side, the investment in energy sector has seen a constant decline. I mean, I was listening to Total and they said it's 50% of what it used to be in 2014. And that perhaps is the reason for crude price volatility.
There has been growth, but the energy sector hasn't seen the kind of investments which is required in the last 6-7 years, and partly because the traditional fuels like oil and gas and coal saw diminished investments, but those haven't come into the renewable energy sector, clean energy sector in adequate measure. As a consequence, we have had a shortfall in kind of investments, and what is happening is that the moment demand picks up, the prices start spiking immediately. We've seen that happen in the last few months, right? So I think we have to significantly step up on investments, especially in clean energy, but maybe in the transition time also in the traditional energy forms as well.
It's going to be quite a balancing act, right, Anish, when you say that you have to start investing in renewables, but also in case of fossil fuels. Having said that, what's your sense on where the crude prices are heading?
No, I agree with that. In fact, in the global energy community, leadership community at KPMG, we are of the common view that the investments which were required in oil and gas sector have not happened and are not happening. So the moment demand picks up, you're going to see a reflection of that in the prices. So we are fairly bearish on prices. It will go up before it stabilizes, or maybe we don't know even. If investments don't go into the international oil companies in adequate measure, then we might see sustained high prices.
So Anish, when you say high prices, how high are we talking? Because everybody seems to be talking about $100 a barrel coming. Is that what KPMG is also putting out?
Yeah, and let me be more explicit. $100 is very much a possibility, and we might see higher levels as well.
Paul, what's your own sense? Because $100 really seems to be becoming an anonymous figure right now. It's just a matter of time, whether it's going to be in 2022 or 23. What's your own sense?
I think we've been talking about the investment shortfall for some years, and for one, US shale has been a mitigating factor. It's provided a bit of a ceiling to oil prices for some time, and it's the first time now we're talking about whether US shale can start plugging that gap. Since it's 2 million barrels a day were wiped out from the coronavirus and what happened there. And from Platts Analytics perspective, we see probably shale coming back maybe 1 million barrels a day in 2022. Plus there's the questions about whether Iran can come back. It's the talks of stalls. We're at a 50-50 maybe whether that 1.5 million barrels a day of Iranian crude can come back next year. That's potentially 2.5 million barrels a day that could help plug some of that demand growth, depending on the trajectory of demand. So I think there's that, but there is certainly, you've seen what a lot of investment banks have been talking about of this real shortfall that could happen, and there is a risk of it, but I think it's still some way off. Remember, high prices, if high prices stay around $80, $85, $90 a barrel, around that level, it starts to incentivize investment into oil and gas and could help further down the line mitigate some of that shortfall. But certainly we're at a situation where oil and gas investment is needed if we're going to mitigate shortfall, even if people like from the International Energy Agency, Fatih Birol, and those are talking about the need for energy transition renewables to plug that gap as well. And I think one thing we're also overlooking in this debate is demand side policies. We talk about supply and what supply can do and investment there, but what about demand and how to shape that demand for certain energy? Remember that we've got a huge amount of urbanization going on through Asia, through Africa as well potentially, and how do you mitigate change some of that demand practices from fossil fuels to renewables or a more carbon circular economy?
And it's not just about crude or energy in that sense. It's about various raw materials as well. So whether it is about cement, coal, or steel for that matter. Anish, would you say that the high cost of transition, as most raw material prices have surged, is going to be yet another concern?
So the first thing is that this is a natural process. Whenever you have, kind of sudden focus on some materials, and the supply side is not ready and the sentiments are not quite there, then inevitably prices go up, and they go up before they come down. So the hope is that if there's no shortage of those materials in general, but it's a more mining or manufacturing challenge, then eventually they will come down once, the whole production base increases. But if there's a shortage on some of them, and there are specters of shortage on some of those metals, then we might see sustained high prices. So that is something which is a possibility. The second part of it is when have they been factored into the costing? I don't think anybody yet has done it fully. And in fact, some sense you don't even know what to factor in because there's so much of volatility. There is no kind of forward curves which are reliable where you can factor in a lot of those things. So as a consequence, we need to kind of learn on the go. But the good thing is that the direction is clear, that you have to go low carbon. So as long as people are following that direction, some of those costs will present themselves and they have to be absorbed on the go.
Fair point that. So, Paul, what's your sense then? Because, both of you are saying that it is going to be a fight about investments on renewables and fossil fuels, and fossil fuel demand is not going away in a jiffy. I mean, you guys have put numbers until 2050 that we might be looking at $100 per barrel, 100 barrels per day of a demand there. So, for a consuming country like India, where we are consuming 5.5 million barrels right now, which could only perhaps be going higher from here, what is your sense, Paul, on what kind of prices are we looking ahead at?
In terms of, if you talk about for oil or you talk about cross commodity, but I think what's important here is that prices of everything is likely to be going up. I mean, we talk about copper is a big one. It's in the energy transition process. Certain resources, we're certainly resource shy of certain metals, the rare earth metals that will go into, say, electric vehicles, for example. And I think you talk about a fight between fossil fuels and energy transition, but actually it's about being joined up. It's about meeting energy needs and a joined up approach to solving some of these issues. We talk about electricity, for example. I mean, electricity comes from either fossil fuels or renewables, and sometimes we could forget that when we're lighting our homes or plugging in our cars for electric vehicles. And where that electricity comes from is going to be crucial. Supporting the grids, the national grids for countries is going to be crucial as well. And storage for energy. We're already seeing with the natural gas crisis and the coal shortages about having enough storage in place. Oil is quite unique in terms of since the mid-70s, we've had oil storage in place across all the OECD countries. China's been building out their strategic reserves. So has India. The importance of having energy reserves is more important than ever.
Point taken that, yes. So whether it's going to be fossil fuels where the prices are expected to go higher, or it's about renewables where you have copper, electricity, or natural gas for that matter, all of those prices are also running up. So well put that, yes, get ready for higher commodity prices going forward, whichever way you look there. Thank you so much, Anish and Paul, for joining us and putting that in perspective. With that note, it's time for a short break, but don't go anywhere because we do discuss sustainability and gold mining with World Gold Council's Terry Heyman on the other side.
CNBC TV18, celebrating 22 years of business leadership.
Come and see treasures yet unseen. Listen to tales untold. Fall in love with flavors from the past. Share memories you'll never forget. And feel a welcome you've never felt. Welcome to a journey you've never imagined. Welcome to Arabia, Saudi.
90% diabetics don't even get themselves checked for it till their vision starts deteriorating or getting affected.
Is at least 10 to 11% of patients with diabetes or diabetic retinopathy have sight-threatening disease.
Eye, kidney, nerve, heart, all these can occur if your diabetes is not controlled, your blood pressure is not controlled.
I think the most important thing is regular monitoring and regular screening.
There are several listed companies in distress with little hopes of turnaround. Steer clear of such counters no matter what the whispers are. These flying rockets will descend as swiftly.
Tune into CNBC TV18 every day as we help you safeguard your money and invest wisely with our Investor Safety Initiative. Start a new tradition. Create a purpose. Leave an impact. Leave a contribution. Leave a legacy. Leave your mark, not a carbon footprint. Let's come together to chart out a green plan to create a sustainable future. Sense and Sustainability. A CNBC TV18 initiative.
News is about stories. Stories that matter to you and to me. With the biggest newsmakers and the most in-depth analysis. We cut through the clutter and get down to the brass tacks.
Brass Tacks, weeknights at 8:57 on CNN News 18.
What is money? How much money should a nation create? Who benefits from too much money? And who benefits from too little? How much should money cost? Who should allocate money? And on what values? Every week, we seek answers to these questions with the best minds. Indianomics, the show that questions the politics of economics at these times. This is CNBC TV18 Newsroom, powered by Ebix Cash. CNBC TV18, celebrating 22 years of business leadership.
Welcome back. And sustainability, decarbonizing and climate changes are some of the buzzwords that each industry is looking at, and so is the gold mining industry. Joining me now is Terry Heyman, CFO at the World Gold Council, to talk about the same. Terry, hi. How do you look at sustainability when it comes to gold mining? Because there have been various reports that have been thrown out, including this.
Look, I agree with you. I think sustainability is a really important topic, and it's good to see the interest that there is in sustainability. I have to say, this is a topic that the gold mining sector has been paying attention to for a long time. It's not a new issue for the gold mining sector. And when you think about sustainability in the terms of health and safety and looking after the workforce, managing and protecting the environment, addressing climate change risks, these are all topics that the gold sector has been thinking about and working on for a long time. And where I think we are in the gold is recognizing the increased interest from investors, consumers, other people who are interested in gold, and seeing more questioning about the sustainability credentials. And I think the gold story has a really positive story to tell in both how it manages those risks associated with the environmental and social aspects, and they need to be managed, and it's quite right, and the positive contribution that comes as a result of what is an industry that impacts so many people around the world. And I think that's what we're seeing now is increased interest and increased communication from the gold sector about what it is doing to support global social and economic development.
Terry, also, what is the cost of gold production right now, and what amount of that really gets converted into various activities that you just spoke about?
So look, gold mining is a topic where there's been increased focus over the last few years in terms of helping bring transparency into the costs associated with gold mining. A few years ago, the World Gold Council released the guidance note on all-in costs and all-in sustaining costs that really does provide additional transparency to shareholders, to government, to communities around the cost of gold mining. And our latest work helped further everybody understand the value that's being created and how that value is distributed across these different stakeholder groups. And I think it's really important that there is equitable distribution of the proceeds of gold mining and that is well understood. As I said, over 60% in 2020, in just a one-year snapshot, and it's important to recognize gold mining occurs over a 30 to 50-year period, and you have to look at it in that context. But just in this 1 year, over 60% of the revenue from gold mining sales was distributed in host countries and host communities and provides that opportunity for economic development, for economic growth. So I think the question around the proceeds and understanding the cost, obviously it's different at every individual mine operation, but that data is increasingly in the public domain and available to help everybody understand how you maximize the value from a gold mine and how you do it in a way that it benefits all stakeholders. That's really important. It's also in line with SDG, Sustainable Development Goal number 17, which is all about partnerships. To be successful over the longer term, gold miners have to form effective partnerships with the local communities and the host countries. And part of that is around forming good working relationships. And part of that is about making sure that there is good transparency around the economics and that there is that equitable distribution. And we certainly hope that the work that we have done in putting out this latest report on the social and economic contribution even goes further into deepening those dialogues.
Oh, absolutely, Terry. That really seems to be a top agenda, whether it's energy or mining, as you said, minerals and gold industry clearly seems to be a part of the whole sustainability and decarbonization issue right now. Thank you so much. And with that, it's a wrap on this edition of Commodity Champions. Many thanks for watching. But before we go, we leave you with an update on the crypto markets with our latest offering, Blockchain and Crypto Decoded. Real estate has always been about shelter, investment and status. The metaverse virtual real estate is the new big winner in the crypto world, and the space is booming on the metaverse. Real estate in metaverse is virtual reality. It can't be lived in, but exists only to be bought and sold, built on and even rented out. The metaverse comprises of multiple digital realms. Each is like a 3D virtual city where avatars live, work and play. According to crypto data site DApp, land worth more than $105 million was sold in the past week alone across the 4 largest metaverse sites, which is the Sandbox, Decentraland, CryptoVoxels and Somnium Space. The Sandbox is the leading pack with both the highest number of trades and sales. The Sandbox sold land NFT worth $86 million and recently broke its own record by selling a luxury yacht for $650,000. All these metaverses use the Ethereum currency as a means of payment. Louis Vuitton, Gucci, Burberry and other luxury brands have already entered the metaverse via NFTs. A move that makes company executives optimistic that they will soon generate revenues from leases and advertising for these brands. Justin Bieber performed at a live concert last month, but the show wasn't in a stadium or an arena. Like recent performances from Ariana Grande, The Weeknd and Travis Scott, this concert was held in the metaverse, the online world where the stretches the corner of the internet into immersive 4-dimensional experiences. Investors are watching this space for a digital land boom. They are snapping up concert venues, shopping malls and other properties in the metaverse, anticipating a future in which digital property owners can work with these brands that want a presence in various iterations of the metaverse. The asset management firm Grayscale believes that revenues from virtual gaming world could soon grow to $400 billion in 2025 from $180 billion in 2020.